Now is an opportune time to invest in private real estate. There are two headwinds we're seeing that create real opportunity today to deploy capital into high quality real estate that we believe will generate some attractive risk-adjusted returns. First, operational softness. The operational softness we're seeing is primarily on the revenue side from the excess supply that's being delivered in the market today. Second is the capital markets. It is harder to source debt and equity to acquire private real estate today. That's leaving a lot of buyers out of the marketplace. Equity investors, retail and institutional investors alike are generally allocating more capital to fixed income and less to private real estate. That is creating the opportunity to deploy capital today when pricing is attractive and capital is going away from the sector, and creates the opportunity to generate some attractive risk-adjusted returns for our investors.
Another thing that's happening right now in the marketplace is the government has a bunch of debt, and that debt is very expensive for them. And I don't believe the government can afford runaway interest rates. With a 10-year treasury, bouncing around 4% right now, on 50% of the federal debt has to be refinanced here in the next 2 years. So they can't really afford runaway interest rates. Long-term, 10-year treasury generally is about 150 basis points above the expected inflation rate. The target inflation rate that the Federal Reserve has is a 2% inflation rate. So to get down to 2% on the inflation rate means your 10 years probably coming down to the 3.5% range eventually. And my belief is it's going to range between about 2.5% and 4.5%, depending on the economic cycles overall. When we're buying assets today, we're likely going to be selling those assets in the future when interest rates are lower. So we probably will get better cap rates on the buy side when we sell. So very interesting environment right now, limited competition on the buy side, fewer operators there that we're competing against. The capital just isn't there in play right now. We're buying an NOI at a depressed level at a lower multiple on earnings with higher cap rates. So it's a great time to buy. I invite you to join me and on this journey of investing in private real estate. It's an exciting time to put money to work and look forward to servicing you and doing a great job for you from the entire MLG team.
As a value-add investor, we're always very focused on replacement cost. What we've seen happen over the last couple of years due to significant inflation is replacement cost has run both due to the cost of labor and construction materials. So today, we're able to buy newer product at a deeper discount to replacement cost that we've seen in a long time. What used to be getting a little bit closer to replacement cost back in 21 and 22, we're now seeing at a minimum often 20% discounts to replacement costs and sometimes up to 40%, which is a really unique fact pattern in today's environment.
We dig into the details of supply and demand. We've talked a lot about supply. There's some excess supply in the marketplace today. That's creating some operational challenges and some opportunities on the acquisition. Let's focus on the demand side. The demand side is healthy. Our country has roughly 340 million people, and it's growing roughly 50 basis points a year. So that's 1.7 million people in terms of population growth annually that we can expect. On top of that, we really dig into households and household formation. Our country has roughly 131 million households. That means there's between 2.5 and 2.6 people per household. And the household formation growth, that has exceeded the population growth. If you look back the last 10 years, it's been closer to about 1.25% per year versus the 50 basis points of population growth. If that continues, let's say that household formation grows at 1% annually, we'll need another 1.3 million housing units annually to provide for the additional housing demand that we'll see. The demand story is very much intact and gives us encouragement about deploying capital today, especially in some markets that are seeing demand growth above and beyond the national trends. We expect the demand trends will continue to be a tailwind.
So while I'm here today to talk about why we think today is a unique and opportunistic time to invest in today's real estate cycle, I also want to hit on what hasn't changed for MLG. MLG is a 35-year-old real estate company that has invested through multiple real estate cycles, and we continue to do that today. It's very challenging to time the market and figure out when the bottom is or when the top. So we're focused on investing through real estate cycles and diversifying our investors.
So think about this. We get a tighter market. If concessions 1 month free might cost you 5-6% of your gross revenue in the year. If we go from 91% to 94%, that's another 3%. So that's about 8% overall. And then if we pick up, 6 to 10% rent growth because the market's tighter, all of a sudden you can have gross revenue growth on a particular property being up 15 to 20%. And that's a monster impact on value. So I believe that's coming over the next, 2 to 3 years. And again, another great reason to put money to work in private real estate today. So I thank you for listening today. It's an exciting time to be investing in private real estate. You certainly welcome to take a look at our website. It's mlgcapital.com. And again, thank you for listening today.